Okay, I believe we can start. Well, if anybody else joins throughout the call, I will obviously let them in, but I think we can start. So, this week, I haven't had too many trades. I just still have my analysis from gold, which was left obviously from Monday. So far it played out very nicely. I even got this paper trade running, which is for the YouTube video that I will be uploading. But so far, I believe we'll be mostly chopping around. By the way, daily cycle offer a bunch of nice day trades. So with the daily cycle, I've seen a lot of guys been catching very nice moves. Uh, so congrats for you guys. Okay, quick analysis for everything. And aside the quick analysis, I would also like to explain another technique with the standard deviation Asia range, because obviously you guys know the four patterns of the Asia range pattern, which was in the PDF number 4. So if you guys remember the patterns from PDF number 4, then we can discuss the third pattern from out of the 4 patterns. So that would be with the use of the standard deviation. So that's also one of the things that I told someone earlier, that first I had to teach the standard deviations, and after teaching the standard deviations, I can teach the patterns, because the patterns actually require the standard deviations to work. So it's not only simple pattern recognition in the market, like animal pattern, triangle pattern, flag pattern, stuff like that. So it's mostly a pattern recognition that you will be using with the Asia range standard deviation. So now that you guys actually know more about, and you guys started to know more about the standard deviations, I believe I can start explaining all the patterns throughout the journey, because that was one of the things that we had to cover first. So the standard deviations, and after that the pattern. So that's the only way it will work. So you know what I believe, before we even analyze a couple of things, I think we should definitely talk about those patterns, and the one that I want to show you. So you know what, let's just move to the side. And maybe we could even make this call like in two sections. Like the first part of the video could be like more of educational and explaining patterns, but the second part could be the analysis. So I believe, hey Nico, thanks for joining, Nico. So if you guys actually look at the PDF also, if anybody has it, you know what, I might even bring it up for the screen, just a moment. So I might bring it up. So just a moment, guys. And Nico, you're breathing heavily. Okay, just 1 second, guys. I will bring up the PDF so you guys can see it.
Ora live. Posso interagire.
So they want to see how can I share this, because I only want to show the PDF. 1 second, guys. I will figure this out. Can you guys see the PDF? Just give me some feedback if you can see it. Okay, cool. So let's move this to the side and let's look at this. So, obviously most of this is actually taken from Raim. He calls it actually Asia Vipso. He just calls it differently, but the patterns are all the same. So let's just look at them. So if you take a look at all of these, I actually haven't yet. I actually got a different version of this PDF. So I got a version where I actually show how to use the standard deviations. In the first one, so this particular PDF of the Asian range, I haven't even showed that. So probably is the reason why I haven't showed, because this already got leaked, but I don't care. So just let's move to these ones. So you guys obviously know we got the 4 daily cycles, and it's basically how the market works and how the market would be moving after the Asia range develops, and how the market would move in a single day after the Asia range. So these are the 4 type of possibilities how the market could be moving after the Asia range develops. So London, New York, this is how the market would be moving in terms of day trading. So again, we are still talking about day trading. You guys already know this one. So this one's quite familiar. This is obviously the daily cycle. We already covered this one too. So this is the reversal of the daily cycle. This one would be, I also showed an example with this one, but it's only pattern recognition. So if anybody remembers the first video of the standard deviations, it would look something like this. So let's say we have 2 standard deviations, and the market has a point of interest up here aligning with the standard deviations. So it's pretty simple. We have 4 types of ways that the market could possibly move, and I just want to explain this moment how you will be using the standard deviations on these type of 4 patterns. So all of them require a little bit different style of using the standard deviations. So I believe we could go one by one. Let's say, so let me just mark up these 2. So just imagine we have a point of interest here. Obviously, got the candle there. So the first one would look something like that. We have the market creating a tight Asia range. The market sometimes it sweeps below the Asia range, and sometimes it would even create a daily cycle. So if you notice, this would be here a daily cycle in the market, right? So it's quite obvious. We got the market traded down. This bit could be even trading a little bit more above, or maybe it just creates an equal level with the Asia range. And the main idea behind this is that the market, even though it would be creating a Asia range, a daily cycle, seen as here below. So these 2 are pretty much the same actually. Just here we got actually a better explanation of how to catch this particular trade up here with the standard deviations. So you could imagine that the market would be creating, let's say, the daily cycle in this case, so obviously the continuation, and you would catch the trade about there in New York Open, but we would be still in New York Open here. So it would not be outside of New York Open. So if I'm honest, it's a little bit different because this one would be the New York Open, right? So the New York Open would be the entry, and this bit would be the ending of the day. So in this case, it's slightly different because here this move would still be within the 7 o'clock and 11 o'clock time. So in this particular example, it's different. So we still got this move within the 7 o'clock and 11 o'clock time. But this move on the regular daily cycle wouldn't be necessarily within the 7 o'clock and 11 o'clock time. So that's something you have to notice. So the reason why it will be quite significant to have this particular move within 7 o'clock and 11 o'clock is it will come down to the pattern recognition as well. So if, let's say, you would have the market up here reacting to a order block at 7 o'clock and 11 o'clock, then you could anticipate that the market will react here and give an opportunity to take a short, because it would be within 7 o'clock and 11 o'clock. And, obviously, as I showed, it would be aligning with, let's say, 2 standard deviation. So, in terms of pattern recognition, this will be one of the ways to recognize this pattern. So 7 o'clock and 11 o'clock, the market should be trading up there and coming to a point of interest area. But the regular daily cycle, so we could call this number 1. So this one, the regular daily cycle, which all of you are very familiar with, which is the continuation of the markets. This would be obviously the London 1 o'clock to 5 o'clock, but you want to see the 7 o'clock and 11 o'clock entry here. So I hope you guys can see the difference, that it's an entire time difference in the market. So the pattern is unfolding, and the pattern is arriving to an area in the market at a different time. So I hope you guys can see this. So in this case, 7 o'clock and 11 o'clock would be down here. So that's one of the big differences, to obviously notice the pattern, because something that I said, that initially this would be looking like a daily cycle, right? So the market trades down, trades up, and offers the entry here. But in reality, it would be more of a reversal and a reaction of a point of interest there, because the entry would arrive to this area at 7 o'clock and 11 o'clock. But in this example, we rather have a long position at 7 to 11. So that's one of the big differences between the two patterns. Third one would be, we already told about this one. This is the what? I know it's cut off a little bit here, so this bit is cut off. It's my bad when I was editing it, but you can imagine that we have a low there. So this one is the daily cycle reversal. So we have already mentioned, and we have discussed, that this would be one of the ways you could be able to recognize if the market is in a continuation or a reversal. So noticing if, let's say, is the Asia range high swept in this case. See that? So in this case, we have an Asia range in the market. The market trades down. So you could imagine that the market is trading down in London and New York into this pattern down here. So the market trades down London, and it will offer you an entry, which I will explain how to execute this later on. So I will explain the execution and how to actually take this trade. But in terms of the pattern, what you should be recognizing here is that the market is not sweeping the Asia range high, or obviously the opposite direction, it wouldn't be sweeping the low. So let's say in this example, when the market is not sweeping the Asia range high, is still seen as liquidity in the market. So this part is still seen as liquidity. Whereas you guys already know that in the continuation daily cycle, sorry guys. So you guys already know that in the continuation daily cycle, we would have this part already swept in the market, right? So the low, so the Asian range low is already swept by the London low. But in this case, we do not have the Asian range high swept. So it's left as liquidity in the market. So that would be one of the ways you would notice a trend reversal of the daily cycle. So that's one of the things, you know, that I pointed out, that not all daily cycles are continuations. So it's not every single time that London is bullish, the New York is bullish. Sometimes it's the reversal. So sometimes it's London bullish and New York giving you the entry for the reversal. So this would be that particular example for the reversal. So the way you would notice that the market is not sweeping the high. So that's left as liquidity. And preferably you would like to see actually here a strong move and the market to make a small pullback, retracement, and that would be your entry. So it's pretty much looking like the no break of structure entry. I will tell you more about that, but in a brief context, this is how you have to look at it in terms of pattern recognition. So to keep it simple, if the high is not swept or the low is not swept of the Asia range in London, then you should be expecting a trend reversal in New York and eventually the market to trade above the Asia range high and sweep the liquidity here. So if anybody has any questions about this, just let me know and I will explain. All right, no questions. And again, actually, guys, the standard deviation would be used like that. So you would like to see 1 or 2 standard deviations until the market trades down, 1 or 2 standard deviations, and after that, so about 1 or 2 standard deviations, that's where you would like to see this reversal in the market in 7 o'clock and 11 o'clock once again. So, okay. Yeah, so 7 o'clock, 11 o'clock, that's pretty much something that will always determine the direction and the pattern for you. The last one, which we could call number 4, is kind of different because this particular entry would not be in New York. So it's not 7 o'clock and 11 o'clock. So this would be a London trade. So this would be 1 o'clock to 5 o'clock. So, you know, if as I said, you know, it doesn't matter where you live, you just have to convert the time. The reason why I always refer to New York time, because, you know, this comes from ICT. He also refers to New York time. So, you know, I'm not even converting it. Just change the time on your chart and everything will make perfect sense for you. So this one, 1 o'clock to 5 o'clock. And again, I'm always referring to New York time. So this is New York local time. And the way this pattern would look like, the market is in a tight Asia range. We actually just had this particular pattern on US 30, I think like 2 days ago. So I can even show you an example. So it's something that happened also quite recently. And Asia range would be used, preferably 1 standard deviation or maybe 2. The way you will select, or if it's 1 or 2, that you want to see the standard deviation aligning with the point of interest. So, if one standard deviation is aligning with it, you're going to use 1. If 2, then you're going to use 2. It's quite simple. So again, this particular setup would be the market chased down about 1 standard deviation, and after it chased down 1 standard deviation and it arrives to the point of interest, this candle, then and the market would offer you this no break of structure entry in London. So that would be 1 o'clock to 5 o'clock. And who knows what happens after that? So maybe you would see the market make a reversal in New York, 7 o'clock, 11 o'clock. Who knows what happens after that? But this particular setup would be a London-based entry. So, all these other ones, these are all New York. So this one's New York. This one is New York setup. This one's New York. And this will be London setup. So, also quite a big difference, so all the time and the price that you have to look at. And many times this particular setup would be the London move of the daily cycle. So as I said, maybe the market would be trading up here, make a reversal in New York, 7 to 11, and this particular move with 1 standard deviation would sometimes be this move right there that you see in the normal regular daily cycle we all know about. So I hope this makes sense. If anybody has any questions, guys, let me know before we move to real chart examples. Don't be shy. All right, so no questions. But in case anybody would be just shy of asking, just send your message in the chat room, and I will be able to read it. Okay, sounds good, Nico. Thanks for the feedback, Nico. Okay. So let's just. Oh yes, and also this PDF has a couple of real chart examples, like this one. You guys obviously know this one. I even have the example here. So this is regular daily cycle. When London creates a low of the day, trades above the Asian range, creates the high of the day, and you would pull your fee from the low of the day to the high of the day, and you want to take the trade in New York Open. So this is typical daily cycle. This one would be the trend reversal. So this one would be the trend reversal daily cycle when the cycle is not sweeping the Asia range. So you guys can see that the market trades down. It's not sweeping the Asia range high. It takes out. Look what happens here. So if you guys have, look at this, sweep the smart money trap. See that? So this was also smart money trap. Sweeps it. This would be like 1 or 2 standard deviations, 10 pip sweep, and the market would offer a setup with a pullback and explode. So this is daily cycle reversal, real chart example. Same thing, exactly the same thing. Now this one, we have already discussed this, but it would be the pattern number 1, see? So it's that one. The market has the Asia range, it has an order block right here. So we have an order block here, and 2 standard deviations would be aligning with that, and you take the trade from 7 to 11. So this would be the real chart example of that. So this was actually the 30-minute point of interest in the market. You know, obviously we have a bunch of confluences, like here we have the fair value gap, the order block, but the main idea that here the market would trade up here from 7 o'clock to 11 o'clock. So this is a New York trade, and you would see 2 standard deviations aligning with that. And you know, if it's 1 standard deviation, you choose 1. If it's 2, you choose 2. If it's 3, go with 3. And again, you want to see the standard deviation align with point of interest. So in this case, it's quite obvious that the market is aligning with what? It's aligning with the fair value gap and aligning with the point of interest. And that's 2 standard deviations in the market. And that's your trade. And this one, I haven't included a real chart example of this one in the PDF because I wasn't really finding any. But as I said, this is actually a London trade. So you want to see the market trade here in London, right? So this would be 1 o'clock to 5 o'clock. So we are not only New York session traders. This would be 1 o'clock to 5 o'clock. And the market would trace down 1 standard deviation. And as I said, you know, this is many times is the beginning of the daily cycle. So many times this would be the beginning London move of the daily cycle, where you could even take the trade in New York, right? So I hope this makes sense. And it's quite simple. Market trace down standard deviation that's aligning with point of interest. In this case, I marked it up as a breaker. Market trace down. It either explodes right away, or sometimes it will offer you this type of entry. It makes a small pullback, makes a retracement, and explodes to the upside. Aaron. Okay. ICT uses 5-minute chart for the standard deviation. Aaron, are you thinking about it in terms of marking up the standard deviations, or are you thinking of it in terms of taking the trade? I'm not sure. So if you want to mark up the standard deviation, you want to use the 15-minute time frame. You want to use the 15-minute. So 30-minute is not the best. 15-minute would be the most accurate. And you know, if you do your backtesting, then you would see that the 15-minute is the best. I tried it out a lot of times on the 5-minute, and then I tried it out even on the 1 minute, because you know I also try to be accurate with it, but you will not have too much success with that. So the best and the most accurate for the standard deviation and the Asia range is always the 15-minute. Okay, guys. Okay, so I believe we had quite a nice discussion of this. Let's move back to the trading view. And you know, guys, we got like 10 minutes left, so I will finish explaining this. I will show you guys the examples. So this was the educational part of the video, and the second part will be the breakdown and the chart analysis. So if anybody wants to stay for that, then I'm happy to have you guys. So just a couple examples. We had, I believe it was US 30. Yeah, probably it was here. So I think it was here. So, guys, obviously, New York time, that's what you want to look at. And then you mark up 7 o'clock to midnight. And you should be able to have a nice markup on this. So if you look at the time, now I'm showing you guys the London trade. So the one that I showed the last time. So you guys can see how the daily cycle and the London trade would be working together. Let's try to do everything quickly. And 7 to 11, right? So we got the times 1 o'clock, 5 o'clock, 7 o'clock, 11 o'clock. And you guys will see that how both patterns will be happening in this example. So as I said, many times we can have the London trade with the daily, with the standard deviation and the pullback retracement, as I showed you. So we could have a trade in New York, in London, and we would still be able to trade the daily cycle the same day, the regular daily cycle. So the one when you would take the trade in New York. So here, let's see, one standard deviation, it would be low of the day, and it would be also the beginning of the daily cycle, and this would also be aligning obviously with an optimal trade entry from a low to this high. So you could even be taking this trade on the optimal trade entry alone. But in terms of the example that I showed you guys, we would have the market trading down to one standard deviation. Maybe we should use the bodies. In this case, I think it would be 2. So let's see what happens. Yes, it's even more accurate. See that? So that's why we use the bodies. So sorry about using the wicks. We use the bodies. So it's 2 standard deviations low of the day, and you would see the market in London. So this would be, everything would be unfolding within the 5 o'clock and 1 o'clock and the 5 o'clock time. So the pattern would be unfolding within this time, so 1 o'clock to 5 o'clock. And that's where you would see the market in a sharp drop. It would make a rally and then make a retracement to obviously 62% level and offer you a trade. So it would look something like that. See that? So this would be the first trade you are able to execute in London. And you could even have, which would be very nice, like let's say equal highs above the Asia range. So that's even another confirmation for you that let's say the Asia range would have relative equal highs in this case. So it's even liquidity that you could be looking at, and it would be the draw of liquidity for you. It would work as a magnet. If let's say you have relative equal highs here, and you're taking the trade here and above relative equal highs. Let's see on the 5-minute, maybe we had actually an order block there, which is something nice confluence. So, some people call this like the supply demand area. So see, this is what I've been mentioning, but a lot of times the standard deviations would be aligning with something like a point of interest or or order block, things like that. And also obviously it would also be aligning mostly with the optimal trade entry. But in this case, you can see everything the exact same way that I just showed in the previous example on the PDF. So the market would be trading down 1 or 2 standard deviations that's aligning with the point of interest. It's trading down there. Who knows, you might even be taking a trade like that. But if you're kind of the trader who's waiting for more confirmation, then obviously you're waiting for the pullback and the retracement as I showed you guys also in the PDF. And after that, the day continues, the day goes on, another trade is offered between 7 o'clock and 11 o'clock, and the retracement is at 8 o'clock to 8:30. You guys can see. So 8 o'clock, 8:30. And this would be another trade in the market right there. So, 2 possibilities, one trade in London, another trade in New York, and we are still at the same day, on the same day. You wanna use the target, you can either use fib extension, which you might already know about, fib extension, or you can use old highs or old lows as your target, or even better, you would be using standard deviation, and the standard deviation would be aligning with old highs and old lows. Right there. So you can even target these. See that? 2 standard deviation, that's your trade. You might be asking, why am I pulling the fib from this particular low and not the low of the day? Now, the reason why I would be doing that is, if you look at the 15-minute, this particular move, it wasn't one single move. The market first gave one of optimal trade entry, and then it offered another one. So in the example, when you have something like this, so first a London optimal trade entry, and then a New York, you want to pull your fib not from the low of the day, but from the last swing low, which would be this low. And you guys can see that this is the correct way, because the 62 is right there. And on US 30, I'm gonna use 100 pips as the stop loss and target the 2 standard deviations. And that's your trade. Okay, guys, I will end this recording here and start the next one, because the next one will be the market analysis. So this was another topic, another new topic to digest. And I hope you guys enjoyed it, and I will stop this one. I will send the new link and send the recording after that. So I hope you guys enjoyed it, and I will send the new link for the new meeting right now.